Today on the show,
we really do take a more proactive approach to really make sure you're doing the right things to save taxes at the end of the year.
Getting your taxes straight. Welcome to the Not Another Real Estate Investing Podcast. I'm Dan Riando. I'm joined by Brian Davis once again. Hi, Brian.
Hey, Danny. How you doing today?
Good. We're going to talk tax today, which is, of course, a critical part of any real estate investor. To that end, we've invited Thomas Castelli, who is a CPA and a real estate investor. So he's basically the perfect guy to talk about this. Hey, Thomas, thanks for making time.
Hey, thank you guys for having me today.
Well, we were talking a little bit off air, but to make you repeat yourself here for the audience, why don't you introduce yourself, talk a little bit about your journey, both as a chartered accountant and a real estate investor.
Yeah, so basically, I started out in the real estate world. My great uncle had passed away, and I wanted to wholesale his property and tried to flip it to a house flipper, someone who would develop it and bring it to its highest best use. And in that journey, I ended up attending a networking event, Long Island Real Estate Investment Association event. And from there, I didn't actually get the chance to wholesale that property, but I did meet a group of people who did a three-day seminar on multifamily real estate investing, specifically the syndication process. And from there, I was pretty much hooked on that structure, made a bunch of investments as a limited partner before participating in a syndication along with a team. It was a group effort to do an 82-unit apartment building in Jacksonville, Florida. We wrapped that up in 2017 and I currently have that under management and just going to be on a property management call with them actually today. So that's kind of my real estate investment background. That passion led me to pair my background in accounting and as a CPA to be a tax advisor for people who are in the real estate business, whether they're investor or own a business themselves.
Brian, do you want to jump in and your tax issues and any questions you might have for Thomas?
Typically, a real estate investor is going to make offers, find a deal, put it under contract, buy it, fix it, and resell it. And the only time that we really consider filing our taxes is after we have already gone through the project. And that's not usually something an investor puts up front. But I've found that to be painful in my situation because we ended up buying properties in over 20 different states over the past year and then come to sit down to file our taxes. And it gets very expensive, especially if you don't plan on which entities to put these properties in, which ones to buy them with, which ones to hold them in. And I was just hoping, Thomas, you could maybe talk about if a real estate investor is getting started, how would they want to structure their business so that it makes the most sense for their taxes, they can save the most money, and so that it's not a filing nightmare at the end of the year?
Yeah, absolutely. So one of the things about entities is usually the less entities you have, the better, both from an administrative standpoint and also a filing standpoint. There's a lot of fees associated with it. And depending on how those entities are structured, you may have additional tax filing requirements, which of course cost more money. So kind of the best way to do it if you're going to be in the business of fixing and flipping or wholesaling would be to set up an LLC in the state in which you're going to be flipping those properties, and then elect to have that LLC taxed as an S corporation or an S corp, as they call it. This will allow you to break down the amount of income you have into wages and into distributions. The reason for this is being an active business, which fixing and flipping and wholesaling is considered an active activity as compared to rental activities, which is passive. You are subject to the self-employment tax of 15.3% on that income. So in order to mitigate that 15%, that 15.3%, what we would do is take a look at the amount of income you're generating from the property and your role in the business and determine a reasonable wage. The goal would be to try to get that wage down as low as possible because you're going to be charged that 15.3% on that wage, but not on the distributions. So the lower the wage, the better. The rest of your income will be classified as distributions, and those are not subject to the 15.3%. So that's kind of the main way the best way to kind of structure the entity for maximum tax savings in an active business such as fixing and flipping or wholesaling.
So do you need to set up an S corp and an LLC and have the LLC sit in the S corp? Is that how that works?
Yes. So the way it starts, so an LLC, there's a bunch of different ways you could have an LLC taxed. You could have it taxed as a sole proprietor. So essentially, it would just flow right through to your individual tax returns as if the LLC wasn't there. You could have it taxed as a partnership. You could have it taxed as a C corporation or as an S corporation. So you would establish the LLC, and then you would just elect to have the LLC taxed as an S corporation. So yeah, you essentially you would open up an LLC and then you just file an election, which your CPA could help you file to be taxed as an S corp. It doesn't necessarily sit in it; it is one and the same.
What are some of the things that an investor would have to do having an S corp? Are there certain requirements for them on a yearly basis?
Yeah. So the first requirement, for the most important requirement to know, is that an S corporation does have a separate tax return, or an LLC taxed as an S corporation also has a separate tax return. It's called an 1120S. It's a derivative of the corporate tax return, and you will need to file that in addition to your personal 1040 tax return. So that's one of the first things to understand, and that could cost a bit of money. So you want to make sure you talk about with your tax advisor if setting up this entity structure and electing to have it taxed as an S corp makes sense for you based on your specific circumstances. But there's also other requirements required, including keeping minutes, official board meetings, which you can talk to the attorney who sets up your LLC on what those requirements are. But they are there, and you will have to hold those meetings, because if you do not, you could potentially pierce the corporate veil.
Right. And so how about with a buy and hold investor? Typically, we're talking on a fix and flipper or a wholesaler. But if somebody is going to just buy and hold a property and then refinance out of it, what do you think might be the best entity for them to put the property in? And do you think that a new entity is required for every property that somebody purchases?
Okay, so when it comes to rental real estate, what's important to understand about entities is it really comes down to liability more than tax purposes. Like having an LLC for rental real estate, it's going to usually be passed down right to you in your personal returns anyway, because you either have a single member LLC, which is taxed as a sole proprietorship, or a partnership, which is taxed as a partnership, and you will get a K1 that goes directly into your personal tax returns. So from a tax perspective, it really doesn't make a difference. It's more of a liability thing. So if you're going to want to protect yourself, you'd want to speak to an attorney about it, obviously, because we are not attorneys. But what you could do is put it into an LLC and just elect to either have it taxed as sole proprietorship or a partnership. If you're going to have more than one member in that LLC, it's typically the best way to do it from a tax perspective. And usually, as for having multiple properties in an LLC, or should you have one LLC for each property, that's really how comfortable you are with having multiple properties in one LLC. Because again, if there's ever to be any litigation you might face, you might open up that entire LLC to a lawsuit or something along those lines if you have more than one property in the LLC. So that's really a personal preference on how comfortable you are with the risk.
Getting off of the tax stuff, I think people can only handle about 3 to 4 minutes of tax strategy talk. Let's talk a little bit about your real estate experience and that property in Florida that you had mentioned. Could you give us a little background on maybe how that came together and what that property currently looks like, and maybe the future of that project?
Yeah, absolutely. So yeah, I started out as a limited partner in a bunch of my mentors' deals, and I always strove to be an active investor, a general partner. And what that it requires really was either you got to find a good deal, or you have to bring money to the table, either from yourself or investors, to get that general partnership stake, which is the more desired stake to have in these type of deals. And in order to do that, I basically had to make a bunch of cold calls and establish a relationship with either property managers or brokers in the area who would give me the time of day to actually take me seriously, to send me good properties. So what we basically did was, we were looking in Kentucky for a while for properties, and I was making a bunch of cold calls to property owners down there, and things just really weren't making sense. People wanted too much money for what the property was worth. So we never actually found much in Kentucky that I was able to get in on the general partnership side. But then we started discussing Jacksonville, Florida, and my mentor actually put me in touch with a property manager. Had a conversation with the property manager down there, and she told me a bunch of brokers that she was working with. So I went ahead and called those brokers and got a little bit of a relationship established with one of them. And he sent me a few properties that they weren't really so good. But then he sent me another one that looked like it had something there. So I went ahead and sent it over to the team I was working with, and they happened to agree that there was something there. And we ended up putting that property under a contract. We sent it over an LOI, and we negotiated the deal and got it under contract. Then went down there, did the due diligence period. And one of the funny things that actually happened during this entire process was Hurricane Irma hit in Florida. So we actually flew down to take a look at the property, and then had to fly down again after Hurricane Irma to make sure nothing happened. And that's when we did the full due diligence.
Would you be comfortable talking about the numbers on the deal, like purchase, renovation, how long you plan to hold it, things like that?
Yeah. So if my memory serves me correctly, we're all in on this property. We purchased the property for $3.8 million, and coming in with I believe it was a $220,000 renovation budget. And this property is only a slight value add. Value add, again, is pretty much like fixing and flipping on steroids, where you just go in and you renovate each unit in an apartment building, bring it up to its highest and best use, and then raise the rents, which increases the NOI, which increases the value of the property. The NOI is net operating income. So our plan for the property is to, when we purchased it, I think it was about 92 or 93% occupied. So what we're doing is, as the units normally turn, as the leases expire, we're going to go in and renovate the units and bring them up to their highest best use, and kind of renew those leases at the new rate. So it's going to be a slower process. It's not like we're going to go and evict everybody and then go renovate the units and release it up from the ground up. But kind of as people leave, we'll get them released. And then eventually we're going to sell the property projected in 5 years.
And how many units was that?
It was 82 units.
82 units.
Yep. And we're actually exploring turning one of the storage sheds into another unit. So it could possibly be 83 units by the time we're done with it.
Cool. And how are you guys increasing the NOI? What are the things that you're doing? Do you have anything different?
Yeah. So, I mean, kind of one of the things we're doing is we're going to be adding a fitness center to the property. It seems a lot of properties down there have these fitness centers. So that's an amenity that you could charge a premium for. But the main value add strategy we're using is just cleaning up the units themselves. Some of these units haven't been renovated in quite some time. So what we could do is we go in there and just bring those units up to kind of where the market is. So what our competitors are doing in the area, bringing those units up to that new standard, and that's going to allow us to charge more rents. And we're also going to be doing some other improvements to try to lower the expenses of the property. So both those things, both increasing the rents and lowering some of the expenses, is what's going to drive that NOI increase.
Yeah, what's your average rent over there?
The average rent, I think it's about $8. It's about $8.23 right now. I think if the last time I took a look at it, I'd have to take a look at the new property management report to double check on that. But it's around $8.23, I believe.
Yeah, and then where do you guys end up bringing that rent to?
I think we're trying to bring it up to $8.50 right now, but it's kind of going to be as the market continues to progress. Just looking at the competitors, how far can we push it? Sometimes we might say, they always say if you have a property it's 100% occupied, then you're charging too little. So right now, I think we're still sitting around the mid 90s in occupancy. So we're just gonna keep pushing rents until we get pushback and we can't rent it out. If we're just gonna keep pushing rents as time goes on, pretty much.
Yeah, so it's a pretty solid property, 92% occupancy, and 200,000 in a rehab. That doesn't seem too extensive for that large of a of a building. Huh?
Yeah, it's not too aggressive. Again, we bought this; it was stabilized. The people who owned it before did a bit of work to it. This is kind of more or less like, okay, we can go in and just kind of fix up the rest of the stuff that wasn't done. Not too much of an aggressive strategy. I mean, I've been a part of other deals before where we've vacated the entire building and renovated the entire thing before leasing it back up, and that's kind of a little bit more aggressive. But this property really didn't require that. It was stabilized, it's running well. So it's just a matter of we're just going for that little increase more than that huge increase.
Yeah, and then market research. How did you determine that you would look in Kentucky? What brought you to Jacksonville? What were you doing to figure out where you were going to buy?
Yeah, well, the first thing we look at is the state we're investing in landlord friendly. That's typically the most important factor. I know I'm from New York. I know you're from Connecticut. Not too sure about how Connecticut works, landlord laws, but I know New York, it's very tenant friendly. It can be very hard to evict somebody. So we don't want to do that. We want to be in a state that's landlord friendly, which both Kentucky and Florida are. So that was the first criteria. The second criteria, which is probably maybe even more important, is job growth, job and population growth. Is this area prone? Are companies moving in there? And one of the things specifically about Jacksonville was there's a ton of jobs going over there. Amazon's opening up new sites. I think last time I checked, they were opening up 4 new sites with 4,000 new jobs going into 2019. So that was new jobs. There's a bunch of other employers moving in over there. I think E&Y, Ernst and Young opened up something over there with a bunch of new jobs coming in. So that's kind of the most important part. We also in Kentucky at the time when we were looking, they were going over. The town was actually they were having a ton of tax credits, going to revitalize their downtown. And kind of the area where we were looking at was in Kentucky was an area called Covington. Covington is right outside, right across the Ohio River, which is a few miles away from Cincinnati. And in Cincinnati, they were opening up a brand new GE building. GE was going to be hiring, I think it was somewhere upwards of 2,000 new jobs just miles away from there where we were investing. So job growth is super important.
Could you talk a little bit about how you financed the deal? So you were saying that you found some brokers that would talk to you, give you the time of day, and then this property was sent to you guys. You evaluated it. It looked like something you were interested in. You sent over the letter of intent, but then you need to finance this deal. What does that look like on your end?
Absolutely. So part of this deal was financed through Freddie and Fannie financing. Forgot which one exactly we used off the top of my head. This is quite a while ago, but basically the people who were buying, there was someone buying it before us who fell out of contract. So they had CBRE, one of the bigger lenders, go through the appraisal process and do all the inspections and everything on it. So they came in with 80% loan to value financing on the property. So they covered about 80% of the financing. So then we had to raise, I believe we ended up raising $1,222,000 that we had to come up with. And we ended up going with a company called Realty Shares. They're a crowdfunding company that ended up coming in with 90% of that $1,200,000 number. And we just filled the rest in with our personal equity. So yeah, Realty Shares did a great job of doing that because we didn't actually have to go out and find individual investors to come in on this deal. They just did it all in one quick swoop, if you will. So that was a blessing. That was a blessing for us to go through that experience.
Right. Do you know how long that was to get approved through Realty Shares to be able to put that together?
Yeah, it was relatively quickly to get approved by Realty Shares. I think it was like 2 or 3 weeks. We had a compressed due diligence period. We originally started with 37 days. Normally you have maybe 60 to 90 days depending on the circumstances. But given the fact that the lenders had already did a majority of the work, we were able to compress that. So I think we ended up getting the entire thing closed in 37 days, and Realty Shares only took about 2 weeks to approve and raise the money for that deal.
And then what's the future look like for you, Thomas, in terms of real estate and and as a tax strategist?
Yeah, well, every day I'm real estate's pretty much my life at this point. Constantly reading, listening to podcasts, trying to improve my knowledge of real estate, both on the investing side and on the tax side, to be better strategist and better advisor to our clients at the CPA firm. But on the investing side, my future kind of looks like right now. After I did that deal, I started talking to more brokers after that, trying to find more deals and stuff. Just the market's so tight right now. Cap rates are so compressed. A lot of stuff just isn't making sense. So what I took a step back and said, hey, look, is the best use of my time right now really going to be scouting for deals? Analyzing deal after deal after deal that just isn't going to make sense? Or should I take a step back, build my network, build my investor base, so that next time I go into a deal, next time I do find a good deal when the market's a little bit looser, which hopefully will happen over the next few years, I'll be able to go and execute much more quickly. So on the investing side, I'm taking a back seat for now. We'll be back for sure in the next few years, but I'm more or less focusing on helping Brandon and the rest of the team at the Real Estate CPA build the company.
And do you have anything you want to plug on the show before we wrap it up?
Yeah, if you guys are interested in proactive tax strategy and planning, and just need someone who you can bounce something off of, who actually understands the situations that you put yourself in, and how to actually advise and be a little bit more active on making sure you're doing the right things to save taxes at the end of the year, we're definitely the firm that could help you out with it. Again, most of our tax strategists are either in a real estate trader business themselves, or they are part of a family that is in the real estate trader business. So they're close to it. They understand what's going on, and we're proactive. A lot of CPAs out there, what they'll do is you'll go to them for year-end tax compliance, and that's about it. You might have a phone call here or there, but we really do take a more proactive approach to really make sure you're doing the right things to save taxes at the end of the year.
Thomas, thanks for making time for us.
Anytime.
If you want to learn more about Thomas Castelli, you can visit him at his website, thomascastelli.com. We'll have a link to that in the show notes. What are you reading this week, Brian?
I'm reading a book called Living with a SEAL, and it's a book about a Navy SEAL that ended up, his name is David Goggins, and he was out of the military, and he ended up going to a race that he gave himself about 3 days to prep for. And he had to run 100 miles in order to qualify for he had to run about 100 miles or 100 miles just to qualify for an ultra marathon. And when he was there, it was just him. And there was this guy named, I believe it's Jesse Itzler. He's the author of the book. And he saw this guy that seemed pretty heavy to be running. He was like a power lifter, this guy, David Goggins. And he was there with his lawn chair, some Myoplex, and some Ritz crackers. Apparently, he's like a 250-pound Navy SEAL power lifter type of guy. And he ended up running, from what I heard from David Goggins on an interview I listened to on the Joe Rogan podcast. He ran about 70 miles and then he sat down and he couldn't get back up. And he did this in about 12 or 13 hours. And then this guy, he ended up gutting out the last 30 miles of this race to qualify. And this guy, Jesse Itzler, he saw him there and he thought it was pretty amazing that he came by himself and was able to do that. He ended up contacting David Goggins and convinced him to come live with him for 31 days for a month. And this guy, David Goggins, said, as long as you do whatever I tell you to do. And he put this guy through hell. And it's kind of the story about David Goggins and how he came there, and Jesse Itzler's experience with it. Something I'd really encourage people to do is go check out the David Goggins podcast or the Joe Rogan podcast with David Goggins and you get a pretty good idea of how intense this guy is. He's probably about the baddest man you're going to find walking around. So I just encourage people to either check out that book or check out the interview with Joe Rogan.
Living with a SEAL, 31 Days Training with the Toughest Man on the Planet is by Jesse Itzler. There'll be a link to that in the show notes along with that interview with Joe Rogan. That's all the time we have for this edition of the show. You can rate the podcast at Apple Podcasts. We'll see you next time.